Good morning and welcome to today's webcast. Report Fiduciary Activities, Key Steps for Governments. Before we begin, I'm going to play a brief housekeeping video.
Welcome, and thanks for joining us. We're pleased to present another in our ongoing series of continuing professional education webcasts to help companies and individuals conquer challenges as they plan for what's next. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget to the right of the slide view. You can ask our presenter questions during the webcast by typing a question in the Q&A window below the slide view and clicking submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% of the polling questions, which we'll ask throughout today's presentation. To respond to a poll, click the button next to your answer. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget to open a PDF file that you can save to your computer. Don't worry if you can't download your PDF certificate today. We'll email a copy to you in 2 weeks. If you're attending this webcast in a group, you must complete our attendance sheet to receive CPE credit. The attendance sheet is available in the slide deck and handouts widget. Please have all group members sign it and send only 1 sheet per group. Also note that CPE credit can be awarded only to participants registered as themselves and isn't available to participants who view the on-demand version. As a reminder, the presentation you're about to see isn't legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
I'm pleased to introduce today's presenters, Kory Hoggan, partner, and Amanda McCleary-Moore, also partner. And with that, I'll turn it over to Amanda to get us started.
Thank you, Emily. Our agenda today is to walk you through the standard, discuss some tools that will help you analyze your activities, and then we will end with some examples from the implementation guide, which is currently an exposure draft in draft form, but has some good material out there. Before we get into the standard, sorry about that. Before we get into the standard, it is important to understand why GASB addressed fiduciary activities in the first place. What GASB found, and which I would say is consistent with what we have been seeing in practice, is that there is a wide diversity in practice on how the previous guidance regarding fiduciary activities was applied. For instance, fiduciary activities of similar circumstances were reported more often in general governance, but not necessarily consistent in business-type special-purpose governments. The previous guidance required governments to include the activities of organizations that do not meet the requirements for inclusion in the financial reporting entity that the primary government has fiduciary responsibility for, which was pretty vague. Because it was vague, entities were applying different criteria in determining the existence of fiduciary relationships and reporting. Before we move on through the new standard, we have our first polling question.
All right, our first polling question. How prepared are you to implement GASB 84? A, I hope it doesn't apply to me. B, this is my first seminar on GASB 84. C, we are researching and analyzing our funds for proper classification. Or D, we early adopted last year. And I'll give everyone a few moments to respond. To participate in our polls today, please click the button next to the answer you choose and hit submit. If you're having any difficulty seeing our polls, please try refreshing your browser. And let's go ahead and take a look at the results. back to you.
Interesting. It's nice to see some people have early adopted last year. Hopefully this will just be a reiteration of the information that you've already used to adopt. And for those of us that are going through our first seminar here today, hopefully we can provide you with some good tools to move forward.
And for those that selected A, I hope we don't deliver bad news today.
So there are 4 types of fiduciary funds addressed in paragraphs 15 through 18 of GASB 84, which are pension and other post-employment benefit trust funds, investment trust funds, private purpose trust funds, and then custodial funds. The main difference here is the terminology of custodial funds, which were previously what would have been presented as your agency funds. Some examples of some fiduciary activities that should be evaluated for potential inclusion in the fiduciary funds include items such as activities held for another organization or individuals, circuit court funds of another government, 401k plans, which is one activity that I believe there to be widely diverse in practice right now, so maybe some clarification there. Cemetery trust funds, minors trusts, post-employment benefits, and jail inmate accounts or nursing home patient accounts. And this list is not necessarily meant to be all-inclusive of all potential fiduciary activities. We just wanted to provide some examples of activities that we frequently see and that should be evaluated. One activity of note that is not included on this list is payroll taxes withheld from employees' checks. We've seen where some governments transfer to a fiduciary fund until paid, which would not be appropriate under the new standard. This is just one example of practice that definitely was varying between governments on how that was reported. And then all of these examples are specifically addressed in that exposure draft of the implementation guide that's out there. So you can look to that guide for examples of how these are reported. And we'll touch on a few of those today. Next, Kory's going to walk you through the definitions of the fiduciary funds.
Thank you. So I'm just going to briefly summarize the 4 types of fiduciary funds that are defined in the standard. Some of this is new information that was issued in the standard. Some of it is similar to what's been in practice already. The first category of fiduciary fund, and perhaps the most common to most governmental reporters, are pensions and other benefit trust funds, or OPEB plans. These are plans that are administered through trust arrangements as defined in GASB 67 or GASB 74 for OPEB plans. And what's interesting here is this includes both defined benefit and defined contribution plans in most cases. I know when GASB 84 was first issued, a lot of people knew that it included DB plans or pension plans because that was already kind of the common practice. Many people were surprised to hear, though, that it also includes defined contribution plans, such as 401k plans, 403b plans, and most 457 plans that might be sponsored by a governmental reporter. And we'll talk a little bit more about that in a minute. But if you look up the criteria that's in Statement 67 or 74, it lists out the criteria that qualifies these plans, and those defines these plans. And typically that's if the plan has contributions from an employer that are irrevocable. In other words, that those contributions are going into a trust, and the government or the employer can't pull that money back out and use it for general purposes. The assets are dedicated to providing pension or OPEB benefits to their plan members. The assets are legally protected from creditors of the employer, of the pension plan itself, or the OPEB, or any non-employer contributors. The second category that's defined in the standard are those non-pension, these would be non-pension pooled investments or investment pool trusts. So again, it's as defined in paragraph 11C1 of GASB 84. These would be those trusts that are administered in a trust arrangement where the government is not a beneficiary. It's dedicated to providing benefits to other recipients, and again, legally protected from the creditors of the government or from other service providers to that trust. With both the pension and the investment trust funds, it's important to use the flowcharts that are in the standard, and Amanda's going to go over those in a minute. It provides kind of a decision tree to determine whether the government has control of the funds in those, controls the assets in those fiduciary funds, and determines the government's administrative involvement with those assets. Those are key terms in this standard to kind of determine the fiduciary responsibility that the government has, and helps determine whether these are reported as fiduciary trusts or component units of the government. Moving on here, the third category that's defined are private purpose trust funds. And these are a lot of the examples that Amanda mentioned a minute ago. These are those unclaimed property funds, inmate accounts, nursing home patient accounts, court funds, minors trust funds, etc. These are trusts where the government is holding assets that are dedicated to provide benefits to other recipients, and again, legally protected from creditors. But these are outside trusts that are defined where the government is holding assets or investments or deposits for other parties. And finally, this is the final category has a new name this year, but really in the standard, these are the custodial funds, and this is really the replacement for what we now know as agency funds in the financial statements. These are fiduciary activities that aren't reported in pension or OPEB trusts or any of the other categories. It's kind of a catch-all, but they're still assets that meet the criteria in paragraph 11C1, which is that paragraph that defines the other categories. These funds are reported separately from the others. And the thing that's interesting about GASB 84 is that in the past, as you know, agency funds were only reported under the statement of net position or the balance sheet format, and you weren't required to report the activity during the year. Under GASB 84, that has changed. Agency funds are going away, and custodial funds, as well as the other categories of fiduciary funds, are required to be reported in both the statement of net position and the changes in net position for the year. Now, there is one exception in the standard. If you report as a business type activity, enterprise funds, you're not required to include the separate statement of fiduciary net position if you're only holding assets for 3 months or less. In other words, you have very short-term holdings of fiduciary assets as part of your normal operations. You wouldn't need to include those as fiduciary trust funds and report them separately. What you would do in those cases is report them as a separate asset on your statement of net position, and then report an offsetting liability for that balance in your regular statement of net position. So again, on financial reporting, if you're an enterprise fund or a business type activity, you may not have had, or probably have not had, a separate set of statements in your financial statement before, and there is a good example of what these should look like in the illustration in Appendix D of GASB 84 itself that shows what these statements should look like. But essentially what you're doing is presenting a separate set of financial statements for the fiduciary trust. You have a statement of fiduciary net position, which aggregates the four types or four categories defined in the standard in separate columns. So you would group, if you have individual component units that fall under each category, you would group those component units by category and essentially have the four, if you had all four columns, you would have up to four columns in that statement of fiduciary net position. And then likewise in the statement of changes in fiduciary net position, you would have them aggregated and presented by category. So it's time for our second polling question.
All right.
How many funds do you expect to review for proper classification upon implementing GASB 84? A is 0, B would be 1 to 3, C 4 to 10, D 10 plus. And again, please record your answer and hit submit.
All right, I think we can go ahead and take a look at the results.
Okay, great. A good mix of funds or activities that you're going to have to look at and determine how to report. So Kory kind of mentioned the charts and the flow charts in the back of GASB 84, so we're going to go through those next. And that should be able to help you in all of these cases document whether or not a fiduciary activity needs to be reported in a fiduciary fund. So in Appendix C of the statement, there are 3 flow charts in the back. They're intended to aid in the application of the standard. Chart 1 is designed to provide assistance in evaluating and reporting potential fiduciary activities that meet those requirements of the standards. The flowcharts, just a note there, is that they're really considered non-authoritative, so they're very good flowcharts, but they don't cover all aspects of the statement. But they are good tools. You can use these to help document your evaluation, to go through the evaluation of the different activities that you have, and it can even assist in your documentation process as the time comes when you go through audit and you need to provide some level of documentation. It is a good tool for that, but just keep in mind that it does not cover all of the aspects of the standard. So we're going to walk through these at a pretty high level, and then we're going to come back later and actually walk through an example that'll take you through the different charts. But as you're looking at this one, this is chart 1 in the back, and the first question to really kick off your analysis is, are these assets held by a legally separate entity that is considered a component unit? So is it a legal entity that has its own reporting? If the answer is yes, and the component unit is an OPEB or a pension arrangement, they actually get their own chart for analysis. So you can see that flows down to the bottom to chart 1B. So anything that really has to do with a pension or an OPEB arrangement will flow to that other chart, and we will go through that as well. You can see that in this case from this, as soon as you do answer the fact that you do have a component unit that you're analyzing, what's interesting to note here is that all the responses would lead to some sort of reporting, which makes sense. If you go back up to the top of the chart, though, this is an important piece to point out is that if you're dealing with assets that are not held by a component unit, you need to determine if the government controls those assets. And then if they do control the assets, we'll go through chart 1A. And then if they don't control the assets, that is an instance when that activity would not be reported in your financial statements. So how do you determine whether or not the government does actually have control over those assets? As I mentioned on the last slide, it's a key piece to really understanding how you apply the standard So an entity will control the assets if it holds them, or if they have the ability to direct the use, exchange, or employment of the assets in a manner that provides benefits to the specified or intended recipients. A government only needs to meet one of these two definitions in order to determine whether or not they have control of the assets. One item of note is that restrictions from any sort of legal or external restraints that stipulate that the assets can only be used for a very specific purpose does not negate the fact that the government still does have some sort of control of those assets. So just because there might be some sort of outside restriction, that doesn't necessarily mean that you would change the conclusion that the government does in fact control those assets. The next chart we're going to walk through is Chart 1A. So this one is designed to assist in evaluating and reporting potential fiduciary activities for assets held by a legally separate entity that do not meet the definition of a component unit as defined by Statement 14. But the government does control the assets. So in this case, they have control over them, and then you have to do some further evaluation to determine how those will be reported. So if the government either holds them or has the ability to direct the use of those assets, you get directed here from Chart 1. So as you are looking at this chart, the two questions that really need to be answered in order to determine how they're reported is, where is the revenue derived from? So as you can see, you're either going to say that does the revenue come from solely the government's own source revenue, or even potentially non-exchange revenue sources. And if it does not come from the government's resources, then you have some additional questions to evaluate here. And you can see that they're the same three questions that conclude on Chart 1, and really understanding what those assets are to be used for, and who's going to benefit from them. Are they held in a trust? If all the answers to those are no, then you're going to end up reporting these in your governmental or business type activities. Otherwise, these are activities that would be reported in a fiduciary fund. And as I mentioned, we'll walk through an example that will come back to these charts and kind of walk through a scenario to show you how that all plays out. If you notice on the left-hand side, I mentioned that the pension or OPEB arrangements, they do have their own chart. So in this case, they're referring to a situation where you have a pension arrangement or OPEB arrangement that is not considered a component unit. That still leads you to Chart 1B because they have their own chart that evaluates on how to report those types of activities. So the key piece of this is really determining where that revenue comes from that is funding these assets. So in order to really understand that, we should look at the definition for a government's own sourced revenue. So what does that mean? Assets that are derived solely from the government's own source revenue are revenues generated by the government itself, such as an exchange or exchange-like revenue, or deferred or derived tax revenues. Some examples of exchange or exchange-like revenues would be items such as utility charges or water or sewer charges, some sort of charges for services that the government is generating, or something like investment earnings. Some examples of the derived tax revenues is really any kind of, or non-exchange revenues, is be some sort of tax revenue. So this is where you're looking at, property taxes, franchise taxes, sales or income taxes, so those other types of revenue sources. If either of these are the type of revenues that are funding the assets held, then it would be considered the government's own source revenue, which you can see on the flowcharts results in the government reporting them as either governmental or business type activities rather than a fiduciary activity. So it's important to really understand where the revenue is coming from to fund these assets. The last chart is Chart 1B. So this one is the one that that flows through the past the last two charts, and it's really its purpose to evaluate and report potential fiduciary activities related specifically to pension or OPEB arrangements. Both previous charts led to this one if pension or OPEBs were involved. You can see that if pension or OPEB is within the scope of other GASB guidance, you would report as a fiduciary fund. Also, if it meets paragraph 3 of either GASB 67 or GASB 74 for pensions or OPEB, it is essentially saying that the plan is administered through a trust. If neither of those two items are applicable, then you would not report as a fiduciary fund. But based on all the research that we've done so far, it seems like that's going to be relatively rare. It seems that you're going to be reporting most of these activities in fiduciary funds. An example might be where you would have to really evaluate the circumstances of your situation, might be something like a deferred comp plan. And with that, I'm going to turn it over to Kory. Kory's going to start us off by walking through some examples from the exposure draft of the implementation guide for GASB 84. So we have a few of these, and hopefully they'll issue the implementation guide soon, but it's not quite issued yet. But it is out available online if you search for it.
Thanks, Amanda. Yeah, as Amanda mentioned, this exposure draft for GASB 84 was issued back in January of 2019, and when they issued it, GASB issued it, they said that the final version would be issued or released sometime in June. So really expecting that final version to be issued any day now, but I think we need to issue, as always, kind of the cautionary notice here that this is an exposure draft, and that while it's unlikely that the questions or answers in this exposure draft will change significantly, the numbering could change if they were to add something else or move something around in the draft before it's issued in final form. So I just want to go through a handful of some of the questions here that cover some of the topics we've discussed so far. The first one is, should a pension or OPEB plan that is administered through a trust meeting the criteria in GASB 67 or GASB 74 be considered legally separate from the employer, non-employer contributing entities, and the plan administrator for financial reporting purposes? And again, that goes back to kind of that first decision tree box that you come to in the flow chart. And the answer to that is yes. Regardless of whether the pension or the OPEB plan is a defined benefit plan or a defined contribution plan, if it's administered through a trust, it meets the criteria of Statement 67 or 74 and should be considered legally separate from the employer and the plan administrator for financial reporting purposes. If you have a deferred compensation plan, a 457 plan that doesn't have any employer contributions, and the employer takes the stand that they have no involvement in the plan's administration, they don't, that there's a separately elected governance board for that plan from the employees, that the government makes no funding contributions, the government doesn't dictate the service providers, the menu of investments that are offered through the plan, and is able to show that they really have no control of the assets or administrative involvement in the plan, there could be room there to take a position with those types of plans that it's not a fiduciary activity, but that would be more of the exception than the standard. The second question is actually a really common situation related to retainers for a lot of governments. A city hires a contractor to construct a new city building. The contractor provides the city with a cash deposit to be held by the city as an assurance that the project will be completed on schedule and in accordance with plans and specifications. If the contractor does not complete the project to the city's satisfaction the deposit will be forfeited to the city. If the contractor does complete the project, the city will refund the deposit. Should the city report this contractor deposit or retainer in a fiduciary fund? And the answer to that is no. This goes back to the criteria in paragraph 12 of 84. The city does have control because they're holding the cash, and the deposit is the result of an exchange transaction. But in this case, the city is holding the cash for its own benefit. They're not holding it for the benefit of other people, other parties. The city is holding onto this deposit for their own security or their own assurance that the project's going to be completed to their satisfaction. So, time for our third polling question. Do you currently present fiduciary funds in your current financial statements? A is no. B is no, but I likely will now with GASB 84. C is yes. And D is yes, but you expect some changes based on the guidance of GASB 84. Give you a few minutes to submit your answers there. No right answer here.
All right, I think we can go ahead and take a look at the results.
So pretty evenly spread, really. And if you look at the first two, about 40% do not currently have fiduciary funds, but of those, roughly half or 15+% likely will now. And I think that's, as you start thinking about implementing this standard, or hopefully you've already started thinking about it, it's really, there aren't cut and dry answers to this, as Amanda touched on when she went through the flow charts. It's really important to look through your accounts and to reach out with your component units and other related parties and take inventory of these types of accounts that you currently have. Not only benefit plans or OPEBs, but other types of trust arrangements that may not be getting reported as fiduciary trusts or agency funds now, and track them through those flow charts to see if they meet the criteria of the standard. I want to move on to another example. This is a case of a higher education institution, a university, receives funds which it controls from alumni to provide for a scholarship program for incoming freshmen who are majoring in business-related fields and have financial need. There's the criteria is that scholarship recipients are required to have a 3.5 grade point average to receive these funds. The university is responsible for selecting the scholarship recipients and monitoring compliance each semester. In that situation, does the university have administrative involvement with the scholarship program, as discussed in Statement 84? And the answer to that one is yes. 2 points there. The university is the one determining who's eligible to receive the scholarship funds. And 2, the university is responsible for monitoring the recipients of those funds for compliance with the scholarship requirements. So the university is, in this case, definitely has administrative involvement in authorizing and monitoring those funds on behalf of the donors. I think with that, I'm going to take a break and hand it back to Amanda to go through a couple more of these.
Amanda, we're going to turn it over to you.
Thanks, Emily. So we're going to use this next example to look at control of assets. And what I would like to do is actually go back to the flowchart and walk this one through the flowchart so you can see how we use that. But first we'll start by just kind of talking about the scenario, and then I am going to do my best to bring back up that flowchart for you so we can walk through there. So in this case, a public university holds funds. So the university has the funds in their possession. They are received from a foundation that is a legally separate organization, so essentially a nonprofit foundation. It, however, is not a component unit of the university in this case. So basically, the university doesn't have financial accountability for the foundation. The funds of the foundation are for the sole purpose of granting science and engineering scholarships at the end of the school year. The funds are contributed by the foundation members and may be withdrawn by the foundation at any time. For a student to receive scholarship funds, they must submit an application to the foundation, and the foundation's executive director then selects the recipient based on the criteria established by the foundation. The recipient's compliance with the scholarship criteria is monitored by the foundation, and then once awarded, the university applies that scholarship award to the recipient's student account. In determining whether those resources are controlled by the university or fiduciary in nature, we need to determine if the assets are for the benefit of an organization that is not part of the financial reporting entity. So I'm going to go back to the first flowchart that we looked at. And so if we go to the top of this, we've already determined that the entity is not a legally separate entity that meets the definition of a component unit of the university. So we're going to answer no there. So then that very important question that we talked about, does the government, or the university in this case, control the assets? And in this case, they do have the assets in their possession, so they hold the assets, so they meet that criteria in paragraph 12. So then let's go over to then chart 1A. So here we know that these are held for scholarship funds, so we know it's not a pension or OPEB, so we don't have to go to chart 1B, so we should be able to get our conclusion here from chart 1A. And so as we talked about, the main question that we need to ask is, where does that revenue come from? So in this case, the contributions are coming from the foundation to the university, and then they're held in an account at the university. But the university is not responsible for, it's not their own source revenue to generate these contributions, and it's not coming from some other non-exchange tax source or anything like that. So we know that this isn't going to be considered their own source revenue. So then we have those last three questions to really go through. And the first one is really whether or not these funds are held in a trust. And when they've come over to the university in this case, they're not held in a trust. And so the answer to that first one would be no. So we would go to the second one, which is related to paragraph 11C2 of the standard. And out of this one, when I first read through this one, I wasn't actually quite sure. And then when it starts talking about the administrative involvement, this example specifically touched on basically there's three criteria to meet administrative involvement, and the university does not have that involvement. It is solely held by the foundation. So the answer there would be no. And then this last one says that the assets are for the benefit of the foundation, which is not part of the university with respect to reporting. So in this case, this is where we get to our yes answer and would be reported as some sort of fiduciary fund there. So kind of fun to just walk through the flow chart in an actual real-life example. It's something that's very common with universities and related foundations. See if I can get back. So as we just went through, the answer is yes, the university is holding those assets, but it's not for the benefit of the university, it's for the benefit of the foundation. So they would report those assets that they're holding as a fiduciary activity in a fiduciary fund. So one last example that we wanted to go over is, this one's really common. I work with a lot of cities and counties, and so this one's very, very common. However, this example from the exposure draft has a little bit of a twist on it, so we thought we'd share this example with you today. Let's see, a county is responsible for collecting property tax, so pretty common, that's very normal, on behalf of other tax levying governments or districts within its jurisdiction. In addition to this, the county collects a fee equal to 1% of the amount billed from the other governments to provide this service. Those taxes are deposited into the county collector's property tax distribution account, which is a custodial fund. Should the county report the fees in the custodial fund with the taxes collected, or how should those be reported? So in this case, you would not report those in a fiduciary fund. All of the examples we've mentioned so far have resulted in some sort of fiduciary fund reporting. But this is an example of where the activity would not be reported in a fiduciary fund. In this case, the county is obligated to provide the collection service for which a fee is charged to the other taxing governments or districts. The nature of that transaction is exchange or exchange-like, so essentially providing charges for services. So they're providing a service to these other governments, resulting in own source revenue. So very key term there, own source revenue of the county. As we discussed previously, it is not a fiduciary activity if the assets are derived from the government's own source revenues. Therefore, the county should report these fees in some sort of governmental fund financial statement. And with that, we have our fourth and final polling question.
All right. Our final polling question. After implementing GASB 84, what is your ideal vacation? A, lying on a beach, somewhere tropical. B, backpacking through a beautiful forest. C, Disneyland, it's the happiest place on earth. Or D, implementing another new standard, maybe GASB 87. And once you have completed all CPE requirements for today, you will be able to download a PDF of your CPE certificate from the certification widget to the right of the slide view. Give everyone a couple more seconds. And let's go ahead and see what everyone has to say. Back to you.
Thank you. So it looks like lying on a beach somewhere tropical is the most popular. I actually, when I was putting this one together, these are all my favorite things, including the next GASB standard. So it's nice to see that I'm not alone there and that there will be some others out there trying to implement that new one. So if you need any assistance in that regard, you know where to find me. So with that, what's next? So need to work on your implementation. That those effective dates are coming up. So if any of you out there have a calendar year financial statement reporting period, you will need to start reporting those activities at the end of this year, which could have some work that needs to be done. As Kory mentioned earlier, you're going to have a flows part of that. If you had agency funds before and now they're the custodial funds, those will report a flow statement, so an income statement like statement out there that previously was not being reported in the financial statement. So maybe some work to do there. For anybody else that's on a fiscal year end, you have until 2020, but same kind of situation, you know, that fiscal year is going to be starting here pretty soon, and so making sure that you have controls in place to implement and be able to properly account for and report on these fiduciary activities is important. So it's great that you were able to call in today and get some more information on how to implement that. Just a couple notes about implementation. The changes adopted to conform to the provisions of the new statement should be applied retroactively by restating financial statements if practical, if you have any sort of comparative statements for all prior periods presented. Not super common, but just a note that it is a retroactive restatement, and that the notes to the financial statement should disclose the nature of restatement and its effect, and also the reason for not stating prior years if you were not able to do that and you present comparative financial statements. So it's coming up fairly soon. And just some things to think about and some takeaways I hope that you got from today's presentation really is, I would start by reading the standard. It's short and it's pretty concise. I think there's only, you know, we mentioned a lot of the paragraphs and their requirements with them. I think there's only a total of 28 paragraphs. So I think reading the standard and would be a really good start. And then you'll want to begin identifying all these potential fiduciary activities that you might have not had reported before, and any of the old ones to see if there's anything that needs to change. And then after that, gather the information regarding who provides the responses, what are the resources, what are the assets used for, who controls them, why, if the government has control over them, why do they have control over them? So really going through those flow charts and asking all of those questions to identify if you have a fiduciary activity to report or not. And then use the flow charts. As I mentioned, they're not a catch-all, but they are great and extremely helpful. So I would download those right out of the standard and help with your initial documentation. And then as soon as, you know, Kory mentioned that the implementation guide is not quite issued yet. It was supposed to be in June. I checked this morning and it's still not in final draft form. So it's out there in exposure draft. So just be cautious when using that. If you do use that to help with any of your documentation, that you do go back to it when it is in final format to make sure that anything didn't change. And then, of course, you can always consult with your auditors or the GASB to make sure that you're on the same page or coming to the right conclusion with going through the standard or the flow charts. And then overall, I would just suggest to act early, act now. Don't wait until you start compiling your financial statements. You'll want to have that information, you know, readily available and ready to implement. So. And with that, we want to thank you for your time, and it looks like we have some time to answer a few of the questions that we've seen come through.
All right. We do have time for questions. If you have questions for Kory or Amanda, you can enter those in the Q&A window beneath the slide view. And let's see what we've got so far. Okay, we withhold employee payroll taxes and other payroll deductions, include them in a separate clearing account, and balances are submitted to the taxing authorities when due. Do we need to report this clearing account as a fiduciary fund?
I can take that one, Kory. So I kind of mentioned this one a little bit when I was talking about the different fiduciary activities. So in this case, at least what we've seen and believe so far is that the government has control of the assets by having them in some sort of clearing account, but the remitted amounts are a liability of the government. So those should not be reported in the custodial account. So you're holding these amounts and they were withheld for your benefit until they're remitted to a taxing authority. So those, and like I said before, when I previously were talking about the fiduciary activities, we know that there's been a lot of difference in how that specific question has been applied, whether it's been in the governmental funds or business type activities or in the fiduciary funds. So I believe this one is specifically addressed in the implementation guide when I was putting my slides together on the fiduciary activities. I know that question had come up before, and so that's why I had mentioned it in there, but it should not be part of the fiduciary activities or the fiduciary fund statements.
Thank you. Let's see, another one here. We have 457 Deferred Compensation Plan. The plan is a defined contribution plan that is funded entirely by employees who elect to participate, and participants direct their investments in their accounts based on the committee that is elected by the employees. Oh, sorry. This is a long one here. Based on the options offered in the plan, the employer does not make any contributions. The plan is overseen by a committee that is elected by the employees. We do not report this plan in our CAFR currently. Will we need to start reporting it under GASB 84?
I'll jump in on this one. I work with a large number of pensions, PERS, and other employee benefit plans, OPEBs and whatnot. And I'm getting this question a lot. This is definitely number one on and even there's several other questions that have been asked during this webinar on that. Defined contribution plans. I think with defined benefit plans, it's fairly straightforward. The government controls those assets and plays a key role in managing those investments. Defined contribution plans, typically speaking, are held in a separate trust. The government is, with the 401k plan is involved with some type of matching arrangement or making contributions to that plan, and plays a large role in administrating that plan. Typically, appointing a governance committee or administering it itself, selecting who the service providers are, monitoring compliance with the, reporting requirements, if the plan's subject to Department of Labor regulations, monitoring compliance with that. So the government or the employer is playing a key role in, fiduciary responsibility for administering that plan. Even though the investments themselves might be directed by the employees in the plan and they might be held in separate accounts. Now with a deferred compensation plan, in this question they're saying that the government does not make contributions, which is typical in a lot of 457 plans. And in this case they're saying that the governance committee is elected by retirees or employees in the plan itself. The government is not appointing anybody, and that committee is making all the decisions related to the plan. And so the answer to that really, it depends. I think you really have to go back to those flow charts, as well as going back to the GASB 14 as amended by GASB 61, that component unit flow charts or questionnaires to determine, first of all, if the plan is a component unit that should be reported, and then does it meet the criteria of a fiduciary trust, under GASB 84. And further on, a lot of times you have circumstances where the PERS or the pension system has been tasked with administering the deferred comp plan or the 401k plan, that the separate pension system already has the board and the framework in place to administer that plan, and it's not the primary government. So then the question becomes, should the PERS be reporting that defined contribution plan and their financial statements, or should it go back to the primary government or the city or county in reporting it? So again, it kind of goes back to those flow charts, and there's not a cut and dry answer. It really is dependent on how the plan is set up and who is administering it, who has set it up and has responsibility for it, and who is fulfilling the fiduciary roles in administering the plan.
Thank you. Okay, let's see. We still have some time for a few more here. How should employer contributions set aside to meet the employer obligation be reported for OPEB and pension plans?
So in other words, it's how should this be reported? Now, this feeds into another question is if you're setting aside employer contributions for say a state pension system, CalPERS for example, and you're not administering the plan itself, you wouldn't be reporting CalPERS in this example, or the state pension system, or even an allocation of that system as a fiduciary trust. You would continue to report out under GASB 68, with your portion of the net pension liability and the other required disclosures for that, because in that situation you're participating in a multiple employer plan. Now, if you were in a agent multiple employer plan where you're having your own valuation done specifically for you as an employer, and you're getting an allocation of the assets in that plan, then again you'd probably need to rethink that and look at those flowcharts, and very likely you would need to report that out as a fiduciary trust. But again, it depends on how the plan is set up and who ultimately has fiduciary responsibility and administrative responsibility for the plan.
Thanks, Kory. Okay, are pension liabilities, deferred inflows, and outflows stemming from GASB 68 now reported as a fiduciary fund?
You want me to take that one, Kory?
Sure.
Okay. So,
it's your turn.
Yeah, that's what I figured. So, I would say overall the answer here would most likely be no. There's probably more information to be gathered on what type of plan you're looking at, but really, regardless, I guess if it's a single employer plan or a cost-sharing plan, I'm assuming in either of those cases, you need to report your deferred inflows, deferred outflows, and your liability in the governmental financial statements. So any sort of government-wide financial statements or your business type activities, financial statements. In what you would be reporting in, say, a trust fund or in a fiduciary fund would actually be the activity of that plan. So this really doesn't get you out of those requirements of GASB 68 to record those liabilities and deferreds on your government-wide statements.
Great. Thank you, Amanda. And we are just about at the top of the hour. If you still have questions for Kory and Amanda, please keep submitting them in the Q&A window, or you may reach out to either of them directly. And thank you, Kory and Amanda, for a great presentation today. As a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet found in the slide deck and handouts icon to the right of the slide view. If you participated as an individual and met all certification requirements, your certificate is available to download now in the CPE progress window. I'll keep the webcast console open for a few minutes to give you time to download your CPE certificate. A copy will be emailed within the next 2 weeks should you have any difficulty downloading it now. Here's a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey as your feedback is very important to us. Thank you for joining us, and we hope you'll join us again next time.